little while. Brief introduction. So my name's Callum Davidson. I look after partnerships and community at Cake. We're really excited to be bringing you our first event for 2022. So that's awesome. So this event today is the first in a series of events, really focusing on what are the different funding sources that startup founders can actually look to tap into to get their investment to grow their startups. We did an event last year which was around angel investing, and it was probably one of our most popular and most engaged events that we had all year. So off the back of that, we thought we'd actually do a series this year, and today we're actually focusing on family offices as the first point. And then we'll be following this up with a number of other funding sources. We'll be looking at crowdfunding, we'll be looking at syndicates, we'll be looking at VCs, etc. over the coming months. So we're really excited to actually kick off 2022 with the event today. Our mission is around streamlining capital raising and employee equity for startup founders. And so one of the most important things in that whole process is understanding where to actually look for those investors. How do they work? How do they invest? And how do you set yourself up to be successful in terms of approaching them to get them to invest in your startup? And so we're really fortunate today to have a panel with some real experts in this space. So we've got Michael Gale from First Penny, who's has a deep expertise in family offices and VC funding into startup space. We've got Jason, who is co-founder of Cake Equity, has literally mentored hundreds and hundreds of startup founders, but also in a past life has actually worked across family offices as well, so understands it from that side of the fence as well. And we've got Humara from the Middle East, who's joined us, who's a startup founder and has actually been tapping into family offices as a source of funding for her startup. So it's great to actually have you all here today. I'll hand over to you to actually provide a little bit more of an introduction, maybe to yourself firstly, Michael, to actually give a bit of an introduction, and then also to actually provide some context around your involvement in this space as well.
Yeah, certainly, and thanks, Cal. It's good to be here. My background, I'm an entrepreneur. I'm a serial tragic entrepreneur. Had my first business in 1977, got into the IT industry when PCs first came out in the early 80s in Australia, ended up in the US. I'm part of the team that built Macromedia that we took public and later sold to Adobe. And a big role in taking Apple into Asia. I was part of F5, Heart, lots of fairly large Silicon Valley companies. Off the back of that, I ended up in the venture space and in investment banking for tech companies, and I've pretty much done that ever since. I've spent a stint running a wealth management platform in Switzerland for family offices out of the Middle East, and primarily out of the UAE and Saudi, where Humera is today. And I also did quite a lot of work in building out an estate management company in Abu Dhabi for wealth transfer that's Sharia compliant. So I've done a lot of work with family offices. I've worked with a number of major family offices in the US over a long time, some of the big ones that people know well, and also in Europe and also here. And because they've always been active in our space, those things. But mostly I've been an entrepreneur and a banker to entrepreneurs, and that's what I do now. First Penny is literally building the entrepreneur's merchant bank, which is sort of, start right from the start through to the finish for entrepreneurs. We have investment banking, we have a couple of funds under management, we do M&A, we do listings. We're in the UK and we're in the Middle East. And we're fairly focused on what we talk about as the ellipse. We're about creating all the value outside of the US because there's such a differential in value. So having spent my whole life in the US, I'm actually doing it outside the US to bring some of the accessibility, get people ready, and then leverage the greater valuations in the US when it makes sense. So that's me. That's what we're about. Just to give it a little bit of context, when you think about raising money as a founder, obviously there's lots of different sources. And as you get further along the journey, you can pick up debt, you can go public, there's all sorts of things. But I'm sort of focused today on the early stage, the real startup seed, maybe through to Series A, that sort of thing. And the principal sources in that space are the angel investors, VCs, and family offices. And it's interesting because the startup journeys become optimized for angel investors and VC investors, but not at all for family offices. And there's some reasons for that. And when I say it's not optimized for family offices to be able to invest well in the space. It's also not optimized for startup founders to go and raise money from family offices. And the reasons are quite simple, actually. Finance is a product like any other, and products need to be sold. And you don't think about this when you think about investors, but in the end, if you're a founder here and there's an investor here, somebody has to sell you the money and then you. Now, with angels, the angels often are using their own labor to find you, and you're using your labor to sell to them. With VCs, you're using your labor to sell to them, or you think you are, and they're using their labor to sell the investors behind them. Because remember, VCs are not investors. They're investor managers. They're managing other people's money. They're an intermediary, right? They're getting paid a management fee and a share of the carry to invest in you, but it's not their money, right? I mean, they always, in all funds, you have to kick in a little bit as the general partner, but they're just another intermediary. So they're brokering the money from pension funds, government sources, and big family offices. So if you think about it, that in our environment, because they're the people investing, so strongly in the startup economy, they're the only people being paid to do it. Family offices make money when they invest and get a good return, but nobody's paying them. If they've got a team out there sourcing venture deals, they've got to pay for it themselves. Angels have to pay for it themselves too, but angels generally are doing smaller deals, and often they have the time, and it's kind of like renovating your own house. You've built it into the capital appreciation. The venture industry is the one place where people are actually being paid to go, and invest the money, and of course the investment banking industry that sits alongside of it. So because of that, that's where there's the most people who wake up every day and their job is to connect with founders. So guess what? Because they're out there, they're the people appearing on panels, talking to people, writing books, hosting conferences, sending venture scouts out everywhere. And that's why, of course, the entire industry has become optimized, and then you've got, governments funding, startup incubators and accelerators. They have to look for industry practice. The only industry practice is the venture industry. So everything's optimized for the venture industry, not because it's a sentient being that's decided to do that, just because it's just market forces. That's the only group of paid people in our ecosystem paid around the funding piece. So they've created naturally, an industry which is totally skewed. I mean, it's completely sort of reverse of how a funnel, like a normal sales process, because they only invest in sort of 1 in 1,000 companies, but people spend 99% of their time optimizing for what the venture industry wants. You've got to have this, you've got to have so much CAGR, SaaS is in fashion this year, fintech's in fashion the next year. You've got to have, you've got to have the perfect 12 slides. You've got to go to these events. And so that in the hope that the venture scouts will bump into you. It's kind of like the old music industry. So you got to understand that about our industry is all the books you read, everything's been optimized for the venture industry because they're the only paid people in the industry. And so it's just a natural artifact. So it feels like getting yourself venture ready is all about appealing to these managers who manage other people's money and invested in you. It feels like that's the most important thing. Now, they're really sophisticated people, and in the same way, the only people being paid, they're the only people who've developed incredibly professional due diligence and ideas. So they are the best of the best at doing this, right? So optimizing for them is not necessarily a bad idea because you're optimizing for this, very, very good process. The reality is, though, if you're most entrepreneurs in the beginning, you're probably not going to get venture funding. There's a lot of other money out there. So that for me is the context of why talking about family office, not because it's necessarily the biggest or the most important, but it's because everybody already knows how to do venture. I can add nothing to the conversation about how do you go and raise venture money. So that's how I think about it.
Great introduction, Michael, and a great scene setting for the overall funding environment we actually find ourselves in. So maybe Jason, I'll hand over to you, and maybe you can do a quick intro and provide a couple of insights as well.
Yeah, just a quick one. Awesome, very interesting intro, Michael. That was really a great way to think about things. Yeah, so I worked for a family office for 5 years prior to getting into the tech space as the CFO and Chief Investment Officer. I wasn't fortunate enough to have a venture allocation at that family office. I'm sure Michael will be used to, and perhaps some of you that have been out in family office land understand, you know, some of these family offices are going to have an allocation to venture and some aren't. You know, and if so, you know, we didn't, and so I didn't get that experience then, but I have since run many rounds, you know, probably 4 or 5 rounds myself for my own companies, and you know, helped and advised startups across the ecosystem. You know, I've been privileged enough to get into the Airtree Explorer program and now do some angel investing myself. And throughout, you know, all these different transactions and interactions I've been having over the last few years have sort of built up a little bit of an understanding of family offices. I would use the word enigma, you know, to explain how I sort of see them, even with the amount of experience that I have, because I feel like they're not super well understood, and they operate under, you know, various different models, you know, based on the different families and their level of experience and the stage of family office that they're at. And, you know, there's quite a few variables when it comes to a family office. So, yeah, so I've pulled together some information for today, you know, to share as we go. And, yeah, really happy to be here and try and, you know, uncover some of these, you know, how family offices work a little bit better to help founders out there. I think you're on mute, mate.
I'll just get you to do an introduction, maybe, and a brief introduction to yourself, and then maybe go back to you, Jason. And I know you've got a couple of slides there you can actually share. So maybe kick off with that in terms of some more context around what family offices are and how they start to think.
Yeah, so I'll do a quick introduction. So I have a startup here in Dubai and now Riyadh. So a lot of different family offices here. And just like what Michael was saying is exactly true. Everything is optimized for like the venture capital market. So like it's very easy to find online, for instance, like you put in your pre-seed, Series A, whatever, and you find 100 funds from all over the world. And especially now, like everyone's investing all over the world. In 2019, when I first started pitching, it wasn't the case. Everyone would kind of be, you know, Silicon Valley startups, and that's it. Like you have to be there. But now it's like anywhere in the world. So it's been working out in that sense, but it's all the information for any kind of fundraising is all VCs, it's all online. It's a little bit trickier to find family offices. They're not all out there. And a lot of people have this perception of like when you come to the Middle East, it's like a ton of wealthy families. You're gonna come here and you're gonna get all this family office money. It's a little bit trickier. I know somebody asked in the Q&A about like how long it takes. I would say it's a little bit slower. And I have worked with family offices in, you know, Seattle, New York, and they're doing a lot of tech stuff. You know, they invest in tech. Here, they're still very like real estate heavy or kind of these other markets. And some of the younger people in the family office are coming in and now trying to do tech or starting to do tech. So we're going to start seeing a lot of that now. So it is a good market to be in for family offices. And there's just a handful of maybe venture capital here. So just from my background, like I said, I'm a startup founder. Launched mid 2020 for the official startup, like the MVP and everything. We raised some angel previously and now just closed a round of funding from, it's also like a structure where it's changing so much here that were kind of family offices before. They were like a telecommunications founder, and it's like a family office that's like now structuring it into like VC because they want to be in the tech scene, and the government's also incentivizing a lot of these people. So it's a little bit of a different market, and I'm sure like Michael and Cal will also talk about how different market family offices may be a little bit different structures, but that's the Middle East. So if anyone's thinking about coming out here, there is a different structure, but there are a lot of family offices. I've met ones in Bahrain, a lot in Saudi Arabia, obviously the UAE, Abu Dhabi, and they're all kind of different in terms of like deals that are going through, and you'll start to see a little bit more going into tech. But a lot of the tech have been abroad. Like we won't see a lot of tech startups being funded here by family offices, just because even the startup ecosystem is new, but we'll still see a lot of that capital going into like the US or UK and other markets.
Just while we're talking about that and looking from a regional perspective, you know, Michael, it'd be great to get your insights in terms of, it seems like there's obviously different levels of maturity in terms of the investing and activity by family offices in different countries. How much of that is kind of driven by taxation incentives across the countries, or how much, or is it more just actually like it's a maturity of the kind of the startup investment ecosystem in general? Do you have any observations around that? And are there particular markets that you see as being standouts for being more sophisticated and more active in startup investing?
Well, I think it's one of those things. It's a bit of a complex equation, right? So, in terms of family offices, there's a lot of regional differences, and so one of the things is they're operating in the environment they're operating in. So, if you look at family offices in the US, obviously, the organized family offices, which were created off the back of foundations. Originally people created, family, foundations for charitable, but for tax reasons, and they set up family offices to manage them. The Rockefellers are really the first people to perfect that in the US. The Rothschilds, obviously, earlier in Europe. And so in the US, there's a certain, in Europe, there's a maturity of the family office, and there's also a maturity of having organized management and structures. And it's definitely those structures are driven by tax. One of the disadvantages, for instance, in the Middle East is because they don't have tax. They have reverse taxation. The government pays people. So a lot of, not just family offices, just broadly and generally, lots of financial instruments don't exist in the Middle East because so many financial instruments, so many ways of organizing companies are tax driven. So that is a big thing. Maturity of the market is a big thing. So obviously, just investment in general, most of the family offices in the Middle East, the wealth was created post 80s because of the petrodollars. Obviously, Europe, it's a lot older. Australia is a bit different. Everywhere's a bit different. China, it's all new. India, it's mostly new, but then you do have these old ones as well, these industrial families. So I think, because that then sort of plays into the thing about which generation are you talking to. There's, all these old saws that people say, the first, starts the business, the second really makes it bloom, the third loses the money. So if you're the third generation, you're terrified of losing the money and you're looking over your shoulder. If you get to the fourth generation, you can get on with it. So part of it is just this sort of which generation. When you talk family offices, I'm less interested. There are some geographic things. So if I'm talking to a family office in the Middle East, I have a different approach to one in Germany, right? Or one in Canada. But I'm usually more interested in which generation's running it, right?
Okay.
So, if you take the Rockefellers where the fifth generation's running it, or the Rothschilds where, the ninth generation's running it, versus, Cannon Brooks' family office where the founder and the entrepreneur is running it. So that's actually probably more important than anything, because the thing about family offices is the money was always made by an entrepreneur or entrepreneurs. The source of wealth for family offices is somebody went and created a business that created wealth. Now, sometimes, depending on the generation of other things, they're now terrified because the first generation took all those risks and the second generation, they made all this money and they're terrified to lose it. So they're ultra conservative, but often there is that idea, and I'll talk about a bit more about this later, but there's that there is an entrepreneurial DNA in family offices. But so regionally, the other thing is, what's the ecosystem? The US has the most specialization of labor. Its economy is very, very specialized. So there's a whole raft of people providing deal flow and deal origination and deal sourcing for family offices. There's a service ecosystem around family offices and optimizing them. And, they all have their own captive insurance company, for instance. And, so the US is very, very different just because bigger market, very specialized, those sorts of things. In other markets, you'll get markets where family offices have worked on sort of a wealth management model where they've appointed somebody to run the money. And the family office is not really making investment decisions. They're picking managers. They own all the horses, but they're picking jockeys all the time. So, so that's a different thing too. So yes, regional is important, but I'd say understanding which generation, where did the money come from, how passive or active are they in managing it? And then there's a big difference between big family offices, because you can, I mean, you have to be a certain size to afford to employ anyone for it to be worthwhile. Otherwise, you do outsource it and clip a fee. To actually have your own staff on board and running it, you've got to be a certain size. So how big, how diversified, and then as Jason said, then you've also got into, do they even have an allocation for venture or alternative assets? Is it all just, liquid securities? So and I think this is part of the issue about family offices compared to VCs. VCs all pretty much work the same way. They're all on the 2% management fee, 20% of the carry. Most of them got their money from pension funds, super funds, PE or hedge funds. Most of them, the models are the same. Most of them are closed end. There are some open ended, but nearly all are closed end. They want to put the money to work within the first 3 years. We're harvesting 5 to 6 years, so they have that mentality. It's much easier with VC to say that they're very alike, and you can,
Yes.
There's always 20% that aren't, but you can optimize. The part of the problem with family offices is they are all very unique and very different. So in the sales cycle, you have to get to know them, but there are other advantages. So 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 the geographic thing's important, but it's not the most important thing.
Yeah, okay. And that's,
for me,
that's a great...
sorry, Cal, for me,
Yeah.
from a founder perspective, just to add to that, and just to a degree, it's the same with any investor. It's about doing your homework. So if you can find out, and this is part of the enigma, quite often you can't find the family office, or quite often the family office will present as an angel. They'll be on a list of angels, but you won't know that they're actually representing a family office. Their checks are much bigger, and so on and so forth. And but at the end of the day, I think as a founder, what you're always trying to find out is, what have they invested in the last 12 months? Were they in your niche? Were they in your stage? Were they in your country? And are they open to investing in the type of offer that you have? This is, founder investor homework 101 is something that I know we all suck at, like even me, because you're under time pressure and, you're just trying to get out there and get it done. You don't do your homework, and then you end up pitching tons of times to people that are never going to invest in you. So, I think, it's great to understand, all these concepts about family offices, definitely. But I think at the end of the day, which family office is right for you quite often comes down to that question. Are they investing in your niche, in the company stage that you're at? And are they active? Probably going to help you a lot. So Cal, I've got a few slides on what is a family office from
Great.
some of the research I did. If you don't mind, I'll throw that up, and please jump in, anyone along the way, and ask questions as we go as well. We'll see how I go. Now, I'm not going to claim to be the owner of this IP. I've sort of blatantly, I don't know what the correct terminology for this is, but I contacted Rain, over the last week, who's a very highly regarded and well-known. Again, comes across as an angel investor, but he's very much a family office investor himself. And I think he has more startup t-shirts than anyone in Australia. So he had recently done a presentation on this that I saw with Blackbird, and so I pinched a bit of good content from him. So thanks, Rain. And if any of you are raising, please make sure you put him on your list. Obviously, do your homework. He and Archangel are doing some great investing, and if you get him on board, you're quite highly likely to get just about everybody else good that you need for your round. So don't forget to hit him up. I'm sure I can help repay his generosity by giving him a good plug there. So as Michael said before, to do 5-10 deals a year, investment managers are seeing 700, 1,000, total decks. They're having 100 or 200 Zooms these days, and they're doing 10 or 20 deep dives. It is good to understand these numbers as a founder. Even if you've been through a few rounds, this normally shocks you into realizing the amount of work that you've got to do, because you've got the same funnel that you've got to get through, right, to get your round done. So, just always assume it's going to be a full-time job for one founder to get your round done. So here's a bit about portfolio management. What I consider to be smart portfolio management. I really liked Rain's presentation, so that's why I guess I've lent on it a lot. So what you'll quite often see, even from a family office, is, diversification. So, they might be backing 30 companies in the first, 2 or 3 years. with about half of their allocation. So just say they had $60, they'd be putting $30 into, 30 companies. And then what they do then is they try and follow on, or a good, smart family office will be then trying to follow on with concentrated investments in the best ones of the 30 that they took. So they're looking for successes, really good metrics and outcomes in the 30, and then they're backing them again. So it's good to know this as well. Sometimes I see founders thinking that every angel investor is going to be their best friend and be their strategic advisor and do everything for them. That's actually not the case. They just can't physically do that from a resource perspective. And they're much more likely to help you once you've shown success, and then they double down in you because they've got more money at stake. So $1 in the first round, $5 in the second round, so $6 in total. What they're looking to then do is, any of their better companies, they want a 10 times return on that, and then that'll return their whole fund. So then, what they're sort of looking at every single time you invest, you pitch a family office or any investor, really, you have to be showing them how your company can return their whole fund. If they can't clearly feel that and see that in the way you pitch, then you're probably going to be unsuccessful, when you're pitching. Again, similar concept here. 80% of the returns from most early stage funds come from the top 1 or 2 companies. We see that with Blackbird. I think somewhere 80-90% of their returns come from Canva. It's a large reasons why that one of the most successful, VCs in the world at the moment. And this is, very common across all, strong investment returns in early stage companies. So here's an example, say, of a particular family office. I think one of these slides I've got, the different sizes. So let me see if I can quickly find that. I think I might have accidentally taken it out of here. Yeah, I took the slide out that had the different sizes. So, you've got your, just high net wealth individuals. They'll normally have like $1 million worth of, liquid assets. And some of those people like to be in risky stuff. So they might invest, 10-20% of their liquid assets in tech. The next level up, you've sort of got maybe $5-10 million. After that, you've got sort of your $10 to $100 million range. Your family office really starts, based on, the research I did, and I'm sure it's plus or minus at around the $100 million mark. So, to really run a family office, as Michael said, to have, the money to hire the team, really, you normally got a CEO and an FC, an investment manager. You might have some property managers and so on and so forth. I know at the Zup family, we started off with about 5 people. And when I left at the end, we had about 15. So, that really can become quite significant businesses when you've got, quite a lot of funds under management. Even still, we were running quite lean. If we were managing other people's money and we had that amount of money, I'm sure we'd have had 2 or 3 times the staff, but, families like to run lean. So anyway, in this circumstance, just say for argument's sake, they've got $100 million, they've allocated 10% into venture. So, which would be $10 million. They want to allocate that over 4 years. So they're taking $5 million and spreading that across 30 investments. And then they're taking the other $5 million and they're doubling down on their better position. So it's important that you understand, again, this isn't exactly how they run. And as we said before, family offices have different levels of sophistication. I really like what Michael said about the generational thing. I think the first generational family offices normally they're good at running businesses. They haven't yet worked out how to be investment managers. The second, third generations, normally when they start to professionalize, and my understanding of really having, a more diversified portfolio, greater capability, to have venture. So you probably want to think about those things when you're going to pitch. I think if you're going to pitch a first generation family office, you probably want to pitch straight into whatever industry they were in when they made their money. Thankfully these days it's probably tech, so it might make it easy for you. It definitely used to be property and various other more traditional businesses, so it made it a bit more difficult, but you'll probably find a lot of first generation family offices now have come from tech, so that'll make your life a bit easier. So then with regards to the story, so it is nice with a family office more so than a VC to talk about the safety net. I think if you're talking to a VC, you're probably talking 20x, 100x. You really want to talk that big game, almost exclusively. They don't really care about 1x at all. But I think family offices like angels, they like to know a bit about the downside. And so just to show them what the worst case scenario is and how you protect their money is quite important. obviously talking about, you know, can you be that dragon and return their fund is important as well. And then can you be that you know, unicorn and really change their life? Because remember, these people got a lot of money. And so to really change their life, you need to really do 100 or 1,000 times return. So, you know, it isn't a bad idea just to have that knowledge in your mind about how can I really move the needle for this family? Because, you know, if they've got 100, 200, 300 million dollars, it's really hard to move the needle for them with a total wealth perspective in mind. So thinking about, you know, what they want as well, you got to know your customer, and your investor's sort of your customer in this case. So, you know, power, impact, money, fame, is it all those things? Try and understand where they have their interest, and, you know, which of these drivers, if any, you can tap into. What sort of questions are you going to be asked? So, of course, how much money do you need? You always need to know how much you need to raise and how long it will last. The milestones that you're going to hit, very important to be able to articulate, you know, what you're going to do with the money and what are the milestones going to be. I normally say, look, focus on how much revenue you're going to get, you know, is the number one thing. And then everything else sort of falls in underneath that. And then, you know, can you raise your next round? Where are you going to raise your next round from? They need to have confidence that they're not going to be the last check that you're going to get. So, you know, making sure that, you know, if you're raising a seed, that you can see where your Series A might come from. If you're raising A, it's even more important. You know, when you're raising your A round, you want to have your B and C round, you know, lined up as much as possible to give the investors confidence to invest. And then obviously they're trying to work out, you know, can you make money? Will the investment help you make more money? And then can they make money? So make sure you remember they're thinking with you, can they make money? You know, don't forget that's their ultimate goal. So, you know, of course they want to come on the mission. Sometimes they do, sometimes they don't. Sometimes it's purely investment. You know, each of us as founders have to decide whether we want to take strategic money or we just want to take money, because at the end of the day, you need money to run your company. Strategic money is better, but it's not always essential. And, you know, trust is probably an underrated commodity in investment in early stage in general. I think taking the time to build the relationship and to build the trust is a critical thing, I think, for family offices more than any. You know, certainly making sure that you understand that you know how to sell, and you show them that you can sell, and, you know, show them what the success can be. So, look, at the end of the day, family offices want this type of thing. They see what's going on in venture. You know, private equity, similarly, they see what's going on in venture. There's incredible returns being had. You know, here's an example. You know, Jason Calacanis led our last round. He's one of the most famous. He turned 25 grand into 125 million with Uber. And, you know, this is the sort of thing that excites family offices, just like any other investor. So don't be scared to hype it up a little bit, because, you know, certainly helps to get people excited and engaged and pitching for you inside the family office as well. So hopefully I didn't take up too much time there, but I thought there was some relevant slides, and yeah, so cool.
Great. Michael, do you have some follow-up to that in terms of just setting the context around the family offices and you know, particularly people that you're dealing with in terms of the Australian market, because a lot of our audience today will be in Australia, so it'd be great to actually just get your thoughts on those areas as well.
Just echoing what Jason said, yeah, I mean, it's a homework issue. I mean, my feeling is it's definitely a lot of work to do the homework and get into family offices, but there's some simple things you can do to sort of narrow the funnel. But it's worth doing the work. And the reason is that, for all the reasons Jason was talking about, I mean, family offices, like everybody else, want to get into investing in startups because there's fabulous returns. And all of the wealth that matters in our economy, I mean, we've gone from when the venture industry started in the 70s and the tech scene to there being fabulous wealth created, to all the wealth has been created now. And it always was before. In the Industrial Revolution, it was all about entrepreneurs. There was kind of a bit of a weird period, I guess, post-World War II, where industrialization really did lead, and, you know, and all the sort of the government recovery from the war led to a lot of growth being driven by huge companies that were publicly listed, and you certainly get that with, you know, big mining investment and the Woolworths of the world and that sort of thing. But gee, it seems like, you know, the exponential wealth and all the innovation, you know, corporations aren't even bothering to fund much R&D anymore. They just buy people who've done it, and the risk is all outsourced. The economy is becoming just so much more where all the risk, all the innovation is occurring in startups, in founder-led businesses, right? And so you can't just wait till things are on. The market's changed. So a strategy that worked as an investor before doesn't work anymore, because if the wealth is being created outside of the big public companies, and the big public companies are so, you know, are so overpriced because of the printing of money, it's very, very hard. Now, you can run a good, safe strategy. You can ride the markets, and when the markets go up, you go up, and when the markets go down, you go down. So last couple of years, governments printed a huge amount of money. It went into the markets. Everyone's a genius stock picker, and everyone's made money. But you have no control over that, right? You are just being towed along behind a super tanker in your dinghy. Where the interesting money is made, where the outsized, abnormal, undeserved returns come from, and that's what we're all looking for, right? Where those come from is from betting on some entrepreneur who may or may not be crazy, who's decided they can jump out of a plane with a bunch of silk and a thread and make a parachute before they hit the ground, and you're going to do really well out of that. Everybody lives that dream. Everyone wants to invest in that. But it's less of this crazy, innovative idea. It's now mainstream, the mainstream of innovation. Look at what just happened with the pandemic and these vaccines. They're all created in tiny labs. You know, Pfizer didn't create their vaccine, right? AstraZeneca didn't create their vaccine. These are small entrepreneurial teams. Now, they might have been entrepreneurial well, the Germans were, but the Oxford team, entrepreneurial in an academic setting, but still same thing, entrepreneurial. So much of the innovation, things that are changing the world, are happening around entrepreneurs. So for family offices, how the hell do you connect with them? You can't wait for it to come up, you know, in the public markets. You can't wait for it to be some derivative that you can trade. So you're in this situation. So they are looking. So that's the biggest thing that's changed, is there's real hunger for these deals. People want the deals. They don't want to miss out. So going back to the, like, what do you do? Well, first of all, work out, you know, who is investing, but nearly all family offices want to invest. Now, they don't know how to find the deals. They don't have people, they're not paying people to go and find the deals. And even if they are, their venture allocation is still going to be a small percentage of their overall allocation, including running their existing businesses. Often they still own the businesses that made the money, or some big real estate portfolio that came out of that. So they aren't out there, they're not optimized. The person you're dealing with is also managing other things. So you've got to make the journey easy, but you can do the research, as Jason said. And if you think about the research, there's some pretty obvious places to start with. You know, are there any visible investments by them in your sector? And where did they make their money? Like, if you've got the, you know, a new opportunity to disrupt things in the drone delivery service, well, you know, you might go and say, well, who made money? So I don't know, maybe Toll Group, maybe the Little family office, because they made their money and they sold out, right? So you do need to think about what's the source of the money, because the good thing is, even if the people in the family making the decisions today, some of them will be the entrepreneurs that made the money, so they'll have affinity for the business where it came from. Some will have heard it from their parents or their grandparents, but they've all grown up hearing the stories about, gee, there was that time when you couldn't get trucks, so we drove the truck ourselves and delivered to all our customers, or we had to get on the shop floor, or we used to make this ourselves, or the bank wouldn't lend us any more money and we were going broke, so we did this risky deal. Or they grew up with those stories, whether they're like from 1 or 2 or 3 generations. So the first thing is just look at where you've got to look at who's made money in our sector. So we do this all the time. You know, we just did a project where, you know, somebody's working in a particular sector, and we just went and looked at all the family offices who have money, and the money came out of, and particularly if they've exited the business, so they're no longer in there.
Yes.
So I think you just have to do that research, narrow it down. And then the second thing, which we haven't talked about so much yet, is completely how do you present to them? Because I think you've then got to present against the things that make sense to them. And you've got to remember they're not VCs. So VCs have people who will sit with a spreadsheet and analyze your CAGR for 2 weeks because that makes sense. Family office, they don't care about that. They're not, some family offices will do that. They're much more likely to care about, more interested in your customers and what's the customer journey and the customer experience. They're looking for validation from other investors. They want to understand the market. And I think the other thing too that is really important to remember with family offices, venture investors nearly always want to know that this can be a global play, a Canva, an Afterpay, and it becomes a global play because that's what will get them, the big upside. A lot of family offices are fine if you just build out and you own the Australian market or the UK market. And this is the other most important thing. Because venture is closed-end funds and they need to get in and out in 5 to 7 years, they invest from the beginning focused on the exit. How quickly will someone else buy you or will get to, listing your stock? Family offices often don't ever need to sell their investment. They might have something that started in the family that's been around for 100 years. What they then want is dividends. Now, VCs never want dividends because they're useless to them, right? That's how they make their money. So they always optimize for you to spend all the money, grow really fast and get capital gain. Family offices, they may be actually more interested in when are you going to get profitable. Don't take the risk to break into the American or the Indian market, become profitable here. So then you have the problem, well, can I have venture and family? You got to understand the exits and make sure that you're happy with that, because it's not always, they're not the same, because it's different way of measuring it.
So if you end up with a VC and a family office and they have very different objectives from that investment, the time horizon and the return profile and whatnot, that could be problematic. So you need to understand that and think about it.
Well, VCs often won't invest if a family office is in there. Yep. And they won't invest often if they, one of the things that always makes a lot of sense often is to get a strategic investor, to get a corporate, right? And corporates is something we haven't talked about, and today's not today to talk about it. But corporate investors are a bit like family offices. They're another underloved sector by entrepreneurs. And a good strategic corporate fund or corporate investor can be an amazing thing and take you to market. The worry, of course, is that then you have to sell your business to them because no one else or people won't. And so VC hates investing when there's a strategic investor. You'd think they would love it, but they hate it because they're worried it'll mess up the exit. Now, if there's 10 strategic investors, it's okay, but usually an entrepreneur can't do that. As an entrepreneur, getting into bed with one big strategic that later buys you, and you haven't had the dilution from venture and they're prepared to pay a higher valuation, and they're not just looking at the absolute return and the value of your company, they're looking at how you help them sell more of their stuff. That might be better. So so some of this is about understanding what are the exit drivers of the investor. And again, family office, some family offices, and the bigger they are, more sophisticated. And the big ones are investing in the VC funds, so they understand it. So, but not all VC will play with family office, and family offices will normally play with VC, but the VCs don't always welcome them. So that's just yet another thing to think about.
That's probably a nice segue back to you, Humera, because I think you spoke about strategic investors yourself. And in terms of your startup. So it'd be great to get your insights from a founder around how you're thinking about that as you're actually building your cap table and your investor list.
Yeah, it's so true. Like everything that was said. Jason's deck was amazing. I feel like I need to go back and pitch a bunch of family offices now. But yeah, so no, exactly what Michael says. Like honestly, it's so different. Like with VCs, it's very like I'm so I pitch like hundreds of VCs, even with the previous startup. So I'm just like, you're used to the questions that they're going to ask, and it is very much, business model, whatever. And I'm just like a robot now. Like I know exactly what they're going to say. So I'm like, I feel like I should sound more excited when I'm pitching my startup, but at this stage, I'm just like a robot because it's the same questions, right? So you know what to expect, which is great. But family offices, when I was pitching some, it's like always so different, right? And it really depends, again, like the generation that you're pitching to, if they've invested in other startups, if they've invested in this region or what stages. And it is kind of all over the place. You can do research. Sometimes they'll come in early. They don't have like that mandate necessarily of like, we only do this, industry or this check size or whatever. It's kind of like they're kind of feeling it out, and especially I'm talking specifically in this region. So I've had questions like, again, like with the dividends, where it's like, what's our monthly, return going to be? And I'm like, well, it's not really like that. Because I guess they weren't like used to investing in startups. And I'm like, you have to wait till I get or like IPO or something. Like, I don't know, all this stuff. And then there's some that are like the younger generation coming in, and it is more about the research where, for instance, this like Saudi family, I think the father had like a bunch of automobile companies, or I don't even know I think it was like, yeah, either auto or construction. I think they're construction or something. And then the younger sons invested in Rivian, which IPO'd for $1 billion, and like very quickly made, really big returns. So it was kind of like these young guys coming in, and for them it was also about proving to their family that like we should invest in tech. And I know in Kuwait there's a family that also like old school auto industry, whatever, and then the kids now invest in like blockchain and crypto, which is very new to like the family, but a few years later they're very successful in it. So it's also like a matter of proving to their family and keeping it up, but like moving into this new line. And in this region you're going to see it a lot because the government's also kind of incentivizing these families to, because a lot of the families are kind of bound by like either Saudi or Kuwait, so it's like they want to like kind of help the economy of the country. So the idea is like, let's bring more tech startups. So now they're starting to look at a lot of tech companies, and it's usually the younger generation. And it is a little bit trickier to find. Like usually it is a matter of read an article and it's like a name that's not a VC fund, or you kind of look at the older families of all these, bigger companies like oil, construction, auto, and then kind of like look through the family lineage, and like, because most of the times they are investing, and they have their portfolios. Yeah, and it is like it's kind of like, I know somebody asked that in the chat. It's kind of like, it's different than VCs. Like all the questions will be structured differently. Sometimes my chats were very informal, just kind of like getting our take on the tech scene and how it's changing. And then some of them were kind of like like what are the dividends or what are monthly returns, and then some of them were kind of wanting to know other, like, it's kind of like vanity metrics mattered in this scenario, because when they're so new and it's like this newer generation, they want to know like who else is investing, who are your clients, so names that like would ring a bell, that would make sense for them to like not take on such a huge risk where I'm just like pitching this warehouse on the moon idea, which is actually a real thing, but where they'll be like, what what is this? So it's kind of like, yeah, yes, it's big in Miami, like founders went and all these people invested millions of dollars into building a warehouse on the moon. But anyway, that's another story. But that, I feel like that's not something a family office might do unless it's cool. But like, yeah, it is usually at this stage, if they're like a newer like generation, they want to look at like, yeah, maybe like a return or big name. So like, it can make sense and not as big of a risk. But later down the line, they'll probably look at, but it is also like, if you are doing the warehouse on the moon and you're like founders fund and Elon Musk and everyone invested, then maybe. But yeah, other than that, it's a lot of vanity, but it's you'll get different conversations each time with them.
And do you have any insights around thinking with your startup around, strategic investors, and then, some of the things that Michael spoke about is maybe if you actually have a strategic investor, that could actually mean that you actually VCs aren't as interested. Has that been a factor for you in terms of thinking about attracting investors?
Yeah, it's always tricky, right? Because like some of the terms are just kind of like, I don't want whatever terms happen now to affect my later funding rounds or whatever the case may be. So it was a matter of like, you have to kind of negotiate. So this strategic investor, like because I'm a solo founder and like obviously coming into this market, and this market is changing so rapidly, it's like kind of the terms, like it almost seemed like they're coming on as a co-founder, where it's like they're already putting really cool people in terms of like clients, and they're raising will help raise like future rounds. So it's kind of like a different type of deal, but that is a thing, right? Like, so my previous startup, it wasn't mine, but I was one of the first 10 people. It exited in New York, and the two founders were hedge fund guys and got acquired within 2 years. We grew from like less than 10 to like 200 people. And now they already did a big SPAC deal, like over $1 billion for an autonomous aircraft company. So these are hedge fund guys that know the numbers, right? So like, which is really important as a startup founder, no matter what industry. So these guys went from recruiting to autonomous aircrafts, exited both, like crazy. But what I learned from them is that they, are very strategic of like who they're letting on the board, if anyone, just because they had their idea of like who to hire, who to, who to sell to or at what stage. And then, recently that company also acquired their largest competitor who had raised over 100 million before they even enter the market. So you really have to understand the numbers, and you really have to look at your long-term vision before making these decisions of who you're bringing onto your cap table, which I think is probably the most important part as you're growing your startup. So whether that's a family office VC, and kind of what are the terms, because you're like, especially at the early stage, you like want the capital, you're thinking about scaling your company, you're not thinking about your future fundraise. You're kind of like, I need this capital to hire this person, get to the next milestone, and keep growing my company. But you kind of miss on the terms of like, okay, this person's taking like a board seat, this is going to affect this future round, and then it kind of might affect the outcome of your company. Unfortunately, it happens a lot. So it's really important to think about that when fundraising. And if it's a little bit easier with like early stage and like a fundraise from a family office, that might work if they're not doing like any, like not interfering too much in terms of like that initial growth. It might make more sense.
Great observations, and it's great to hear from you in terms of you're thinking about that strategic investor, and it sounds like they're not only that's pretty broad a set of value that they're actually bringing to you in terms of future funding and clients and everything, which is excellent. Jason, I'll just throw back to you. We've probably got about 5 minutes to go. I know you've been listening for a while. It'd be great to get some more of your insights in terms of actually, from a founder's perspective, I guess, how do they think about finding these investors? How do they actually prepare to pitch to them as well?
Yeah, cool. Look, I'll just share my screen again here quickly and see what I can do with that. I'll try and keep it brief. Obviously, in my opinion, the preparation phase is the most important phase of a round. Cake does have a capital raising toolkit in here. We've got a bunch of hacks, a step-by-step guide, a whole bunch of resources on how to prepare and run your round. So check that out. I think specifically with family offices, I think you want to prepare like at least as well as a VC, but they can act more like an angel. As Michael said, they don't have the resources of a VC. And they don't have to invest, whereas VCs do. So you do need to understand these dynamics. So I think there was a question from Simon about timing. I would expect normally it would take longer for a family office to invest than say an angel or a VC. But the flip side is there can be a lot of capital there. There can be multiple rounds. They can stick with you longer. So there can be some really positive trade-offs for that. Definitely professionalism is valued. Like I heard this said the other day, but like you have to be good at making friends with rich people, right? And if you haven't come from money and you haven't done that, you need to get experience at like thinking about and hanging out with and becoming friends with people with a hell of a lot of money. And there can be some differences there that you probably want to get around. Not to try and hassle anybody in any way, shape or form, but like just understanding that dynamic can be important. Understanding their operating model. So like how often do they invest? How long do they take? Like we do this with any investor. What's your process? How many people are involved? What have you been doing? Really getting to understand them, makes so much difference. And the worst possible outcome for a founder, and I've seen this so many times, is they follow around one investor for 3 months or 6 months and then they run out of money. And then they have to take money from somewhere that they shouldn't. Now, I'm not saying you shouldn't build up a relationship, but you should just be aware that, you just need to understand how often are they investing? Are they investing in your niche? Probably don't have all your eggs in one basket and stuff like that. Otherwise, you're going to set yourself up for failure, which sort of ties into the do your homework bit that we've already touched on. So look, but like everything in startup land, almost everything about your investment is about you and your mission and your purpose and where you're going. The investor has to want to come with you on that journey. They have to believe that it's important that this mission is achieved. And if you can't articulate that, if you don't have power in the way you present, and if you can't bring that energy and, be the train and have them want to be coming on the journey with you, then, you're going to be having a bad time. So look, in that capital raising toolkit, there's a big long list of stuff you got to prepare. There's some, there's stuff in that toolkit. Again, I won't go into this now because I think we'll run out of time, but like what are the decks? What are they used for? What meetings do you have? All those sorts of things. Obviously get your cap table all in order because, like if you do the wrong deal with the wrong board seat, you know, in the wrong voting power, or you accidentally sell too much of your company in the first round and then your VCs won't follow on. Like, there's a whole minefield of stuff that you need to get right there as well, which again, I won't bore you with all the detail on now, but definitely do your homework. You know, make sure your cap table, your shareholders agreements all sorted, and you do the best deal you can as well. The best fair deal that you can as well. Yeah, I'll shut up now.
Thanks,
Thanks, Cal.
We've had more questions just about, you know, is there a list? Can Cake build a list of family offices or whatever? Yeah, we've got Airtree's open source investor lists, and there are other investor lists around. Obviously, some of the family offices will be in there, but, you know, there has been some, you know, one of the insights out of this for me is like, you know, family offices are a bit of an enigma, as you said, Jace, right? And even, you know, there might be ones that aren't necessarily actively investing in startups, but because you've actually got a startup that's aligned to an industry or whatever, or where they've actually made money, that could be the catalyst for the investing. But are there any other tips in terms of actually unlocking and actually finding who you should be talking to, and how and where you do that research? Maybe Michael, that'd be a good one for you.
One quick thing for me on this is try and find a gatekeeper. So like, the venture industry is like got heaps of money, but the family office industry does have gatekeepers, and they know the big networks. Michael's definitely one of them, but there are gatekeepers around the world that have these amazing networks, and I would be suggesting trying to find these gatekeepers and making friends with them. I don't know, Michael, over to you.
Yeah, no, I think that's true. And I think, you know, everything's always about people and connectivity. And, you know, when you go to a VC firm, being introduced by somebody they believe and trust and they've invested with before, they know. And it's the same with family offices, probably even a bit more personal with family offices, because they tend to be a bit more private for a number of reasons. So, yeah, I think gatekeepers are very important. I mean, there are lists. I mean, obviously, you know, things like the BRW Rich 200, there's a lot of, you know, wealth management lists around. I mean, you can find lists of family offices. You can have a look at, you know, some of the bigger public companies and who the shareholders are. It's not, I mean, again, if you go back to thinking about your industry, and whichever industry you're in, if you're doing, you know, ag tech, and you start to say, well, you know, we're relevant to cattle farmers, you know, wheat growers, cotton farmers, it's not actually that hard to find out the big companies. Then you look at, are they, the easiest, where family offices show up is if they're still operating a business. The ones that have sold all their businesses and doing purely investment, much harder to find, right? But a lot of them are still have an operating business somewhere. So there's some trucking companies, some supermarkets, some, you know, real estate portfolio, there's something they're operating. So if you look in a sector that's relevant to you and you find big companies, find which ones aren't public, right? So find the private companies, look who owns them. That's generally how we do it.
Awesome. So I don't think we've got any more questions. Actually, sorry, we've got one here, one last one. Any advice regarding working with family offices in regards to for purpose, for profit, so startups? So I don't know if anyone's got any.
That's actually a really good question, because a lot of family offices started from the sort of the foundation idea. You know, VC, of course, is a commercial enterprise, so there's nothing charitable about it. Whereas a lot of family offices are quite charitable. They, you know, they often have quite a sense of giving back, and a lot of them have very active foundations, and it's often an important thing. Again, because family offices are family offices, they don't have this, got to make the money back in 5 years, it's got to be an exit. And like I was talking before about, there can be other outcomes, whole dividends. They don't necessarily have to make money. They can be, and Humira said this before about people wanting to help their country, help their region. So I think, yeah, I think it's a very, very important thing. There can be a whole lot of other things there. And I actually think with family offices, you can lead in a much more human way often. You can talk the bigger picture about society and the good you're doing, and yeah, it's a much broader conversation. So don't be scared to have that conversation. The good thing about the ones with foundations that are operating in the cause space is those do seek publicity, so you can find them. But you find them and then you find the family office that goes with them. And sometimes they're a consortium of 2 or 3 family offices, you know, but like it's obvious if you're in something and the Meyer Foundation's given all this money to all these things, that tells you that the Meyer family, which is actually multiple different family offices, but that tells you that that's probably a good place to start.
Yeah, excellent. And any final questions, Mara? Oh, sorry, final comments before we finish up.
No, I guess not. Just kind of piggybacking off what everyone said, to find them. Yeah, you can learn how to kind of be around more wealthier people, or like ton of events. I know like Dubai, Monaco has like family office events, and you kind of meet people that are within the network. Yeah, and you can like kind of take it from there. But yeah, it's just like you have to kind of be at the right place at the right time too. So start going to more luxurious places and finding people.
Well, that's a great tip. Go to more luxurious places. All right, I'm in.
Michael, any further comments before we wrap up?
No, but that is a good point that Humira makes. There are actually, a number of organised, like Rotosa, people like this, who are organised gatekeepers and literally do run conferences. And that's probably right. If you just like, there are places where family offices more naturally congregate than other places, which usually are because there's good things to do, there's low tax rates and other things. So, but there is some level of organised access as well that you can run through and find those people. We work with some guys out in New York called Visionary, and they do a lot of family office events, and they're do a lot of intermediary work. It's visionary.net, I think, or .io, visionary.io, and they're pretty good. But there's a lot. Rotosa's the one that runs a lot of family office conference, but it's a lot. There are actually events. Yeah, absolutely.
Okay, great. And Jace, before we finish off, any further comments?
No, good luck on the journey. Keep it up. Keep pumping. Good luck with your raising, and really hope that we helped you a bit today. And yeah, hit us up anytime. If you want to catch up again.
Thanks, everyone. Really appreciate your time today and your contribution on the panel. It was an excellent discussion. I think one thing that stood out to me is just like, I've got an image in my mind of VC being much more cookie cutter, and just how actually individualized and how personal your approach can be with the family offices. And it might be harder to actually navigate your way through to find them or whatnot, but it sounds like if you get the right one investing, you can be absolute gold. So it's worthwhile spending some time and energy actually trying to uncover who might be that right fit for your startup. So I said this is the first in a series, so I'm looking forward to doing more events over the coming months around other sources of startup funding. And yeah, all the best for 2022. I hope you smash your goals with your startups, and please feel free to reach out to us at any time at Cake, and I'm sure Amara and Michael are also happy to actually reach out and answer any questions and give you any assistance as well.